let's look at the journey of Nifty in the last 20 years. Okay, this is a simple chart. This is equity journey, a Nifty journey. This is also a journey of a businessman. What I told you, equity is basically investing into businesses, and businesses never go in a straight line. Businesses have ups and downs. 2000 to 2003, 3 years, equity market gave no returns. If you were an investor, you would have thought, oh God, why did I put money in equity? Usse better to fixed income hota. At least I would have got 6-7% return. But then suddenly what happened? 2003 to 2008, for 5 years, we had a major bull run. And at that time, people say, why even have money in fixed income when equity gives so amazing return? And then when 2008 market corrected, then people feel, oh, I was cheated. Why did I put money in equity market? Then again, market rebounded. 2008 to 2014, for 6 years, equity market gave no returns. People's patience got tested. And during these times, when people's patience get tested, I know a lot of investors, they started redeeming because it's a test of patience. And then suddenly from 2014, market started doing well. It corrected a bit. Again, it started doing well. 2018, it corrected. Again, 2020, it moved up. And we thought that markets will do well in 2020. Suddenly, a pandemic came. The world came to a halt. Equity market corrected by 38%. And then again, we have seen some pullback, okay, a bounce back where market has again moved up. Entire journey, the return is around 10.5. Best of returns, obviously equity has a potential of giving very high return. And that's why I'm saying why long term is very, very important. The problem of a human brain is it gives too much importance to what is happening right now. I just rewind things 3 years back. Demonetization was such a big thing. 1.5 years back, GST was such a big thing. Today, I know coronavirus and the pandemic and the COVID-19 is such a big thing. In the long term, honestly, we'll not even remember this. We'll not even remember this because we are giving too much importance to it right now. But in the long term, these things don't even matter because this is a part of any journey of any businessman from a long-term perspective. But the problem of a human brain is it gives too much importance to what is happening right now. I love to keep this chart on my desk because it explains me a very simple principle, very, very simple principle. Don't focus on what is happening right now. Don't focus on what is happening to Sensex or CNBC, what they're saying right now. Look at the big picture. Look at the long-term journey. During good times, don't forget about the idea that you can also have bad times. And during bad times, don't even forget that there will be good times. But the problem of a human brain is when there are bad times, it's very difficult to convince yourself that there will be good times, and vice versa. When there are good times, it's very difficult to convince ourselves, you know what, there's also a possibility of bad times. And that's why knowing good times and bad times helps a person to build a right asset allocation. Let me take it something very, very forward and something very interesting. Okay, this is a very interesting and a very, very powerful chart for me. Very powerful chart for me. This shows the fall. This shows a fall of equity market every year. इसका मतलब हर साल market कितने percent से गिरती है. To explain you this chart, I know this is a slightly heavy chart in terms of understanding, but please understand this example. In 2020, Sensex was 42,000 level, the peak. It went to the bottom of 26,000 level. If I look at a drop, it was 38%. Let's say market rebounds back and it comes to 42,000 level. So if I ask you, what is the return which you made in 2020? You will say 0% because I started with 42, I ended with 42. I asked you, what is the fall from the highest point to the lowest point which you experienced in 2020? You would say 38%. Now, we all know we experienced a 38% fall and we all got scared, very scared looking at the fall. But there is a very interesting line which is very powerful, and I love this line. The only way to deal with fear is to understand fear. This was said by a very famous Nobel Prize winner, Madame Curie. She was the first woman to get a Nobel Prize. In fact, the first woman to get Nobel Prize twice, and that too in different field. She says, the only way to understand fear, okay, is to deal with fear is understand fear. Now, let me markets. Has markets corrected more than 30% in the past? Let me look at history in the last 30 years. 1990, 1991, 92, 93, 94, 95, 96, 97, 98, 99, 2000, 2001, 2004, 2006, 2008. For almost so many years, Every year market has corrected more than 30%. Yes, in the last 10 years, if you look at the global volatility and India's volatility and also global volatility, equity markets were not correcting that much. And suddenly, when we saw a 30% fall, we got scared. But if you look at history, these falls are very, very normal. And this is one thing which I want you to prepare and tell you. If you want to be a good investor, understand such falls in equity market are so normal, so normal. If I tell you that it's going to rain, it rains in Bangalore every year, will you get surprised? You will say it's so normal. If it doesn't rain, that's a problem. Volatility is so normal for equity market, and this chart I love it. Why? Because if I know that equity market corrects every year, so whenever market corrects, I don't even bother about it. And honestly, if you want a view on equity market for another 5 years, 10 years, 15 years, 20 years, 30 years, 40 years, equity market will correct every year. That's the nature of equity market. You can't change the nature of equity market. That's the nature of equity market. Now, let me tell you something very powerful and very interesting. This formula was taught to us in class 5th maths. Okay, it's called a future value formula. Future value is equal to present value into 1 plus return raised to time. Raised to time. The exponential part is called as time, waqt. The problem is, and let me explain you what do you mean by that. There's a simple formula of compounding, and let me tell you what is compounding. If I tell you कि ना हर एक रोज एक चीज डबल होती है, एक का दो हुआ, दो का चार हुआ, चार का आठ, 8 becomes 16, 16 becomes 32, 32 becomes 64, 64 becomes 128. 1 to 64, you have to take 6 jumps. 64 to 128, for the similar gain, you have to take just one jump. And that's what is called as compounding. The problem is a human linearly, it cannot think in things in an exponential fashion. Let me perspective. If you invest just 1 lakh rupee from a 30-year perspective at 12% return, your 1 lakh will become 9.6 lakhs in 20 years. So you will say, oh God, in 20 years, my value has just increased by 8.5 lakh rupees, not much compounding. But if you just stay invested for another 10 years, your 9.6 lakh becomes 30 lakh rupees. And this is what is compounding. 20 lakh rupees got made in just 10 years. But for your 8.5 lakh to happen, it took 20 years. So technically, compounding happens in the long term because वही पैसा grow होके और बड़ा 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 बनता है. And the problem is we think very linearly. And that's why the most important thing for wealth creation, I've written the heading for that. Time is the best fund manager. And a very interesting point, we smart people have got all the intelligence in the world. Smart people are very impatient. They want to make returns overnight. Smart people want to become overnight, and for that reason, they're never able to create wealth. This game is not about intelligence. This game is about patience. All you have to do, all you have to do is be patient from a very, 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 very long-term perspective, very long-term perspective. And that's how wealth gets compounded. Now, this is one bias which I will try to explain you because I'm sure your advisors are doing an amazing job in terms of building your asset allocation. But let me help you with a very interesting point from a psychological perspective, how you should look at asset allocation. This is CT scans of human brains when they deal with money. Whenever you have a profit, it gets registered in a different part of the brain. Whenever you have a loss, it gets registered in a different part of the brain. And behavior says that when anyone has a loss, on an average, it hurts more. Okay. Now, in fact, you know what? When science also is done a very interesting study. When people gamble, there is a chemical which is produced behind the brain. It's called as dopamine. It's the same chemical which is produced when people take drugs. So when actually people are gambling and they say, you know what, I'm doing it for my family, for wealth creation or whatever, they are not doing it for wealth creation. They are basically doing is to get that kick of for dopamine, which gives them a high. And that's why I understand money is an emotional subject. Now you will say, why am I showing this chart or why am I explaining this? There was a very interesting person called as Harry Markovich. He got a Nobel Prize for building a very complicated formula in terms of what should be the asset allocation based on various asset classes. This was based on risk, return, and everything. Now, when which got a Nobel Prize, in a press conference, somebody asked him, Mr. Harry, do you also build your own portfolio based on this formula? He says, no, my portfolio is not based on this formula. My portfolio is based on some other logic. So somebody asked him, sir, what is your logic? He says, I keep 50% of my money in equity and 50% of my money in fixed income. A point taken. What is the logic for that? He says, when market goes up, I feel very happy that I've got 50% equity. And when market falls, I thank God that I've got 50% fixed income. With this portfolio, I can sleep very well. I'll repeat this point and I will bold it and I'll underline it. With this portfolio, I can sleep very well. He said a very interesting point that with this portfolio, he can sleep very well. My idea is very simple. When I was reading this article and this was part of a book, I loved it. And now, learning from that, even I have built up my portfolio in such a way with which I can sleep very well. I will give you my portfolio. I'm around 40 years old. I've got 60% into equity, 30% into debt, and 10% into gold. You might ask me that, Amit, if you believe that equity is such a good asset class, it creates wealth from a long-term perspective, why don't you have 100% in equity? My logic is very simple. I have built a portfolio with which I can sleep very well. When market corrected by 38%, did I felt bad about it? Yes, I did felt bad about it. Was I anxious? Yes, I was anxious. Did I felt did I lose sleep over it? Honestly, no. I didn't even lose sleep for an hour because I had got a cushion of fixed income and gold in my portfolio. When I look at my entire portfolio, I was able to absorb that loss in a very interesting and a simple way. And the best way to, and the most important thing is, don't copy portfolios which others are doing. Understand your own behavior. Understand how sensitive you are to a loss. See, as nature, right from birth, how sensitive we are to a loss, everybody is different. Everybody is unique. And that's part of our DNA. Some children of the same family, somebody are risk taking, somebody are conservative, somebody are moderate, and there is no harm to say I'm moderate or conservative. That's part of your nature. Don't try to copy anyone else. Build a portfolio which is as per your nature. As simple as that. This is one slide, and now I'll come to SIPs and right processes. And this is one thing which not only will help you in investments, but will also help you in life. See, this world is unfortunately not designed to give in a right way. Okay, we give praises based on outcomes. Uh, if India wins a match, we say, okay, if on the last ball, if let's imagine that you require 4 runs and there's a batsman, he hits the ball, okay, and if India wins the match, next day or immediately the commentators will say it was a very good shot, very good player, good fielding of India, good batting from India, good captaincy, good coach, everything good. Last ball, 4 runs required. Unfortunately, if India loses, bad batting, bad player, bad fielding, bad bowling, bad captaincy, bad coach, everything bad. Basically, based on outcome, we decide whether things are good or bad, which is fundamentally wrong. Something which is good, irrespective of the outcome, is good. Something which is bad, irrespective of the outcome, is bad. Let me explain you with the process in terms of how do you deal with it. A good process and a good outcome deserves success. Bad process and a good outcome is dumb luck. Let me give you examples. Let's imagine you go to a casino and you just put money and your money becomes double, and you're after doubling you make it 4 times, 6 times, and you say, boss, I'm smart, I'm intelligent. What I will say, yes, your outcome was good, but don't call yourself smart. It was a bad process, okay, because in long term nobody makes money in casinos. It was a bad process, but you had a good outcome. It was dumb luck. Similarly, I know a lot of people who are buying IPOs. Last 2 3 years, IRCTC, any random IPO which they were coming, they were buying it. And I told them, why are you buying these IPOs? Do you understand the balance sheet of the companies? Do you know what the management is? Do you know how the profitability looks like? Do you know the future of the company? Do you know valuations? He says, I don't care with all these things. All I just know that I've been buying IPOs, and with all the IPOs I've made money. So this method works for me. Don't disturb me. Yes, he had good outcomes, but basically the process was bad. The returns were based on dumb luck. When market corrected today, all his IPOs are not doing well. This clearly shows bad process and good outcome is dumb luck. Don't follow them. Now let me come to a lot of investors who have done SIPs in the last couple of years, and last couple of years the returns are not good. SIP is the world's best process. Why I say it's the world's best process? See, human beings in general are very lazy. If I ask you, we all are in a lockdown scenario. How many of you are doing, honestly, how many of you are doing 2 to 3 hours or 2 hours of honest workout? Okay. I'm sure majority of us are not even doing 15 minutes or half an hour to even 45 minutes of workout. And the reason is simple. Our excuse earlier was that we don't have time. Today we have time, but we are shows the human beings in general are a little lazy. Okay, that's why having a system which beats our laziness is very important. SIP is a forced way of saving. It keeps on investing in a disciplined fashion, in a habitual fashion over a longer period of time. It will not ask you whether markets are good, bad, or whatever. It will just, on a disciplined fashion, just take away your money on a regular basis, build a habit, and try to create wealth from a long term perspective. Amazing process. But in this amazing process, you will have certain periods when SIP will not give good returns. It's very natural, very simple. It's called as bad break. A good process with a bad outcome is bad break. You will have periods where there'll be bad breaks. It's very normal. I clearly remember what Mahendra Singh Dhoni said after the semi-final match when India lost to New Zealand. He made a very interesting video. He says that you are judging everything based only on outcome, but as sportsman, as individual, I follow a certain process and I keep on following the same process again and again. Many times I succeed, but there are certain times my process, in spite of good process, outcomes are not favorable. Don't discuss or don't say just because the outcome was bad, the process was bad. Good process is always a good process. SIP is the best process, most logical process. Don't judge the process just based on the outcome of last 2 3 years. Suddenly, when the markets will do well, again SIP returns will start looking well. Again, I will say, just because markets have done well doesn't mean that you should over allocate to equity at that time. Stick to asset allocation. Stick to equity. Stick to fixed income. Stick to gold. Stick to your goals. That's more important. One more problem which majority of the investors do, problem is called as herd mentality. What do you mean by that? Let's try to understand this with a very simple example. Let's say there are 5 sheep on the mountain and one sheep jumps. If I ask you how many sheep are left, how many sheep are left, your answer is based whether you are looking at this question from a maths perspective or a psychology perspective. If you're looking at this problem from a maths perspective, your answer will be 5 minus 1 is equal to 4. But if you're looking at things from a psychological perspective, you will say if one sheep is jumping, all the other sheep will jump. This is very, very critical. We human beings are also like sheep. We only follow each other. At the same time, we all become bullish. At the same time, we become bearish. Today, it's fashionable that you know what, nahi yaar, sab kuch kharab ho jayega, sab kuch ye ho jayega. And why you're crying? Because everybody is crying. Okay, it's very normal. We love to imitate. Right from childhood, the reason why human species have also survived is because we stayed in group. If the group is crying, even we start crying. If group is laughing, even we start laughing. If group is buying something, even we start doing something. If group is watching something, even we start doing it. All our decisions are based on looking at what others are doing. In investments, it's very fundamentally important. Don't follow others. Build your own plan. Talk to your advisor. Make your own plan. Simple plan. Define your goals, your short term, medium term, long term goal. Define how much risk you can take. Understand the asset classes and just stay invested. The problem is we want exact answers. कितना रिटर्न बनेगा बताओ. ये FD नहीं है, कितना रिटर्न बनेगा. It's like saying if I ask you where do you see yourself 5 years down the line, can you give an answer for that? No. Investment, yes, equity has a potential, it gives in the long term, but how much exact, nobody knows, because It's very difficult to predict things like this. It's not physics or science. It's not physics or chemistry where you have exact answers. Okay, it's not an science. It's not an exact science. So you will not have exact answers. Understand this point. It's a limitation for that. Now, I'll just end this with the last slide before I take your questions. Guys, everyone, there is a chat box. If you have any questions, you can start putting your question on the chat box. Mr. Subramaniam is saying there is no audio. Sir, I think there should be audio. There is some problem in your internet connection. Ideally, there should be audio.
Amit, Akash here.
Yes. Yeah, Akash.
I think we have got one question from Mr. Vishnu Narayan Malviya, and he wanted to know.
I'm very sorry. I'll just finish this last slide and then I'll answer all the questions. Last slide, just last slide. I have to just finish the presentation and then I'll take all the questions.
Sure.
Okay. So I'll just say the last thing, most fundamental point. If you look at the pilot right now, and if you ask him what his job is, honestly, he'll say my job is very boring. And the reason why he says my very job is very boring because the entire plane is automated. It goes in autopilot mode. Only during takeoff and landing, a pilot has to play a role. And that's why he says 1% thrill and 99%. Investment is basically one has to keep their investments as boring as possible. If you want thrill, investment is not for you. See, honestly, your children are not concerned in terms of how much wealth you are making. What they're concerned is whether you are able to save, whether you are able to pay your. My son is not concerned of how much money I make. What he's concerned is, am I able to pay his tuition fee? Am I able to pay his college fee? And when he grows up, will I have sufficient money for his higher education? My wife is honestly not concerned in terms of how much stock ideas I have, how much 10x, 50x, 60x I've made. A simple logic is, do we have sufficient money for our retirement? The idea is the objective of money is to achieve goals. It's not for ego. What do I mean by automation? Just build a very solid plan of diversified mutual funds. Why I say diversified? Because honestly, when you diversify, your risk comes down. Okay, it's very difficult to predict which companies will do well in the future. Today, one might say, okay, invest into this company. Today, with the best companies in the world, which is Apple, Amazon, Facebook, Google, these companies didn't even exist 20 years back. Okay, and we don't even know in 10 years will these companies even exist. The idea is diversification is the most important thing, and mutual funds provide that. That's equity. Even fixed income diversification, very important. Gold for uncertainty, and maybe if in case somebody is an ultra HNI, they can have a real estate as an investment. Okay, what do I mean by thinking long term? The idea is very simple. There was a very interesting study done by Fidelity. They had a fund which had a long history. They wanted to make a marketing campaign. They wrote to all the clients who were early investors who made amazing returns. When they wrote letters, not even a single client replied back. They were very surprised that why didn't the clients reply back? Because they're trying to make a marketing campaign. They realized a very important thing, that all these investors unfortunately had died and their children and their relatives didn't know about the money which they had invested. And that's why they created wealth. And Fidelity came with a very interesting research report. It said something very interesting. To create wealth, don't do anything. And this is very powerful, very, very powerful. We have got a monkey's brain. Okay. And I like to end with this thought. We have got a monkey's brain. Every time we want to do something, कि अभी कोविड आ गया, अब क्या करूं, डिमोनेटाइजेशन अब क्या करूं, इलेक्शन अब क्या करूं, बजट अब क्या करूं, नो रेनफॉल अब क्या करूं, सम असैसिनेशन अब क्या करूं, डोनाल्ड ट्रम्प इज सेइंग दिस, व्हाट डू आई डू, good budget, bad budget, this, that, market today corrected 5%, what do I do? And telling your monkey's brain, don't do anything, don't do anything, don't do anything, don't do anything. Think decades. Don't even discuss 1 year, 2 year, 3 year. Think decades. 1 decade, 2 decade, 3 decade. That's how you create wealth. All the reason why our parents were able to create wealth because they had patience. Unfortunately, they didn't invest into it because they were not aware about it, but they had amazing patience. And when they were investing, they were thinking about real estate from generations. They thought from gold for generations. They even made FDs, which they kept on auto renewing all their life. And unfortunately, equity, which is basically an asset class which is for generations. We talk about 1 year, 2 year, 3 year. In fact, a lot of people talk about 1 month, 2 month, and 3 month. Is this how one invests into equity? We have to just fundamentally question. We have to control our monkey's brain. Be patient and allow your money to grow. All this I had. I'll just finish the last slide. And Akash, then you can ask me all the questions. 1 second. At the end of the day, we all need good friends. Okay, we need honest, good friends who can take care of us. A human being can only explain a human being. Okay, robots can guide us, but a human being can be a friend who knows us better and who can help us. So obviously, a good advisor, a good trustworthy advisor, who is also a friend, philosopher, who understands markets, who understands you, is the most best thing you can have. To have a good advisor is the most luckiest thing one can have. Okay, with this I'll end the session, and I'm happy to answer all your questions, Akash.
Insightful, explained in a very layman terms. So I think everybody would have understood the basics and everything about the market, the volatility and everything.